This meeting is being recorded.
Good morning, everyone. Brett Elliot here. Thanks for joining so far. I'm just going to give it a couple of minutes for a few other people to join us here. We do have quite a few more registered than what we've got in so far. So we'll just give a few more minutes for people to join in and we'll get started. Looks like they're trickling in now. So thank you for joining, everyone. Our first webinar under the reign of King Charles, very momentous occasion. So we're joined today by, firstly, so we're going to go over market drivers for interest rate changes. So a little bit of information on, I guess, what's happened so far to cause the changes, the information that the RBA uses to make those decisions, and a little bit of forecasting as well. That's going to be done by Orlane Hugh-Ghi, who joins us, and then I will go on afterwards to speak a little bit about how that affects borrowers and potential borrowers, and therefore the real estate market more so in general. So, by way of introduction, Orlane Hugh-Ghi joins us from Nab Markets, where they deal with a wide range of different kind of investments. So everything from cash-based investments, shares, hybrids, all the way up to corporate capital raisings for the NAB private clientele, as well as interest rate hedging. And for those that don't know me, I'm Brett Elliot. I'm the finance principal here at Wilson Pateras. I'm actually a mortgage broker, but just work in the Wilson Pateras office exclusively for the Wilson Pateras clientele. So thank you again for joining. And without further ado, Orlane, please go for it.
Thanks, Brett. So as Brett mentioned, my name's Orlane and I work for NAB in our markets division, which is now known as Private Wealth Solutions. So we look after our private self-directed wholesale clients in terms of looking at investment opportunities across different asset classes for them, whether it's in the primary issuance space or whether it's through the secondary market that we can help our clients access. And beyond that, we also look at risk management and hedging for our clients in the interest rate space and also in the foreign currency space. So today, Brett has kindly asked me to join in on the discussion around market drivers for interest rates and basically what we're seeing and what we're seeing in a general view and what we sort of have the discussion with some of our clients around. With that, I might ask Christine to please skip ahead to the next slide, please, Christine. So as unanimously expected, last Tuesday we saw the RBA raise official cash rate by 50 basis points to 2.35%, which is the fourth consecutive 50 basis points increase to date. And the cash rate is now sitting sort of within the realms of neutral and is at its highest level since December 2014. At last Thursday, so subsequent to the RBA meeting, the speech given by RBA's Governor Lowe at the annual Annika Foundation basically suggested four key implications. So number one, that the RBA is likely to slow the pace of rate hikes and downshift to 25 basis point increments at some point, given the lags in the operation of monetary policy and the rapid increase in interest rates over the past 4 months. This could probably be sooner, and a pause is also likely at some point. The second key point or key implication is inflation expectations that are still being assessed to be anchored at target, but a shift in inflation and wage psychology is pretty much the main risk to the outlook. The third sort of key implications is Governor Lowe's keeping the economy on an even keel is pretty much is an aspiration and not a commitment, especially where he notes that, again, in his quote, it is possible to achieve this, but the path here is a narrow one and it is clouded in uncertainty. Lastly, the fourth sort of key implication is the wages outlook, and that is pretty much going to be the risk to still higher interest rates as the RBA continues to see Australian wages outcomes as significantly different to other countries. And reliance on still very low wholesale price index prints may not prove to be wise. So overall, we did assess sort of Governor Lowe's remarks as being consistent with markets' view of RBA downshifting to 25 basis rate increments in the next 2 months, bringing the overall cash rate to 2.85%. So, and again, remembering the next 2 months, October, November, and then the RBA takes a break pretty much till February next year. So thereafter, there is a clear case for the RBA to pause for some time as it assesses the impact from the considerable and rapid tightening to date. Christine, thank you. So this sort of briefly summarises a overview of the past 2 weeks, and it's pretty much momentum in global markets have pretty much remained bearish in the past fortnight, with some solid US data such as ISM and some elements of payroll reports giving yield curves showing it as a lot steeper. So, and AUD rate markets have been quite receptive to less hawkish, as we saw before, signs from the RBA. I had a quick look at some articles which came out yesterday, and I must say that the data I have included in this is pretty much up to date from last week to yesterday's 2 articles. So as we know, things move pretty quickly in markets, so that's something to bear in mind. So I've include a selection of 2 stories from the AFR yesterday that is relevant to this thematic and may have some implications for investors' view of the Australian economy and financial markets. Apologies, I couldn't include the link in there for you because you have to be a paid subscriber, but in summary, lots of focus on upcoming jobs data and out this Thursday and whether this supports a downshift in the pace of rate hikes to 25 basis point increments, while there are signs of inflation pressures easing in the US. The first article there basically talks about price falls, and that is by John Keogh. The author pretty much notes that the weakness in the property market won't stop the RBA from hiking rates further. So far, the median dwelling price in Sydney is down 7.4%, noted in the article from its peak. Melbourne fallen 4.6%, Brisbane 2.6%. So I guess in the whole of the context, a national house price fall of more than 10 to 15% would likely make the RBA nervous because of the likely flow-on effects to consumer spending and housing construction, according to the author. So RBA research published in 2019, as the article highlights, shows house price falls mainly cause consumers to cut spending on things such as new cars and furniture, and a 10% national house price fall is estimated to reduce economic output by 1.2% below its baseline level after 3 years. The second article there that I thought may be of interest as well pretty much highlights that the residential auction clearance rates were 61.7%, broadly similar to the 59.4% from the previous week, which is well down on the 75.7% this time last year. Christine, sorry, the last sort of slide there pretty much shows some of the forecasts that we're seeing. And as you can see on the third line there, RBA target forecasts going up to 2.85%, hovering there, and sort of towards the end of quarter four 2023 as well. So the next line below that, interestingly, is the Australian 3-month BBSW. So that's the base, the rate on top of your margin when you lend. So as you can see, it sort of flattens out at 3.05% at Q2 of 2023. And that's where we start to see in a little bit of pricing in of stability. That's pretty much it from my end, Brett.
Yep. Thank you, Orlane. Very good.
No problems.
So how does all of that impact borrowers or potential borrowers more likely? So I've got some numbers for you there. One thing to understand, I think most people probably generally get the idea of this, but the banks assess borrowers at the actual rate that they're going to pay plus a margin on top. What happened a couple of years ago was that they introduced a floor. As rates were really getting really low, they introduced a floor. So it was the actual rate plus a margin, unless that's too low, in which case they use a floor. And because rates got so low, we were actually below the floor for most lenders for kind of standard owner-occupied debt. So the implication of that was that when the first rate increase came, it was actually absorbed because we were already below the floor anyway. So the first rate increase actually didn't impact things too much. The second one was partially absorbed depending on what kind of loan product you've got, but it's really been after that. So from kind of after May till now, and then the next couple of rate increases that come along that are really going to impact people. And that's where we're going to see a much more dramatic shift in people's borrowing power. So I've put some examples in there at 700,000, kind of more or less average loan amount for metro areas, I would think. You can see the increase is quite dramatic, 25%, something like that increase. And just another translation of that on the final line. So if you could borrow 850 grand pre-April, so before any of these rate changes happen, you're down to about 700,000. It's quite a big difference. It's a percentage based as well. That's not a hard 150, no matter what debt level you're trying to take on, it's percentage based. So, you know, if you're looking at upsizing your house for 1.5 million or something like that, the difference is more pronounced again. Thank you, Christine. So here's an example. So I know there's a few numbers here. Sorry for those that aren't that way inclined. I'm a banker working in an accountant's office, so you knew they were coming. I've restrained myself. So here's a bit of an example, just for a first home buyer. Okay, they're the ones that probably there's most noise about in the news in terms of reduced borrowing capacity. So we've said, look, 80,000 each, 80,000 a piece. I'm thinking late 20s to kind of mid 30s couple, saving money, good income, 10.5 grand odd net per month, with expenses of about 4.5. You know, we've said 1,000 a week on living expenses, maybe a couple of credit cards, something like that. Very typical scenario. Now, on those numbers, just mathematically, at a very slightly per lender, they can borrow about 880,000. Okay. Now, if they're going to buy for their first house, borrowings at 880 with the minimum deposit amount, they need to put up cash of 150,000. That's your deposit, your stamp duty, your mortgage insurance, your conveyancing, you know, little kitty in the bank for after you settle. And I know I've said example for a typical first home buyer, but this is not typical at all. In my experience, people in this kind of scenario, they're not waiting until they've got 150,000 to buy a property. They're saving to about maybe 80,000, then they're looking for a property. Maybe their broker tells them get to 100,000, it's a little bit more comfortable, and they're not going to buy for, you know, mid nines. They're going to buy for mid sixes, something like that. The implication there, some of you might see what I'm getting at here. The implication there is that a reduction in their borrowing capacity hasn't affected them. It doesn't matter for them if their borrowing capacity went from, you know, 980 6 months ago down to 850. Because they weren't going to borrow 980 anyway. They didn't have the cash for it. So interestingly enough, in this scenario, they haven't really been affected yet by the change in how much they can borrow. The effect that they might feel, though, is if there is a decrease in competition for properties, they're going to still have the same income. They're still going to have the same deposit, but maybe their deposit stretches them a little bit further now. So interestingly enough, if there are any first home buyers out there, or if you've got kids or siblings or anything like that that are looking at their first home, tell them, don't listen to all the doom and gloom in the news. Speak to your broker or speak to your bank or whoever it may be, because this news might not be so bad as it sounds. Thank you, Christine. So are rate changes good for borrowers? No, I'm not going to tell you that. It affects everyone differently. Where is the negative effect going to be most pronounced? I think in the couple that have owned their home for maybe 4 or 5 years, they've had a growth in, an increase in equity. So their cash position doesn't matter so much. They're ready to upgrade their home. The first home was a compromise. They didn't get the thing that they wanted. They've been able to save a little bit more. They've had some capital growth, and now they are able to upgrade. That's where you're really going to see the effect. Those people are, they're very, very most commonly restricted by how much they can borrow. And if it's gone down, they're buying for less. Particularly those kinds of properties that they're looking to pick up as well, maybe those more premium kind of Eastern Melbourne suburbs properties, they're probably more enticing for investors as well, maybe wanting to pick up a piece of land. So the competition decrease maybe is not seen as much in their market. For a lot of investors, it's just going to be a mathematical equation anyway. So I think that's where it's going to be. The biggest effect. The other one that I've seen a little bit recently as well is people that have engaged into an off the plan contract. So this would be both maybe higher end apartments, but also house and land packages. So a lot of people have wanted to lock down contracts, building contracts, because of the increase in price. So they've wanted to lock down their building contracts so that they didn't have to keep having a increase in price of the building contract as the cost of materials increase. The problem is they have to wait for their land to title before they can actually get approved for the loan. And a delay in titling that land, which happens in 101% of cases, means that they can't get the financing sorted. They've had to cop all these rate rises, and now they're stuck into these contracts. So there's probably going to be a lot of people affected there. And I would say that, my own opinion, I think that's probably going to be where the biggest effect is going to be evident in the market. The other thing that I wanted to call out as well, sorry, Christine, not specifically related to what I just discussed, but a lot of self-employed clients are going to have FY21 financials done that they're going to want to submit to a bank to borrow off. Obviously, early days to have FY22 done. Now, most banks, the problem with this is most banks that are excluding government grants in their when they assess their income. So I've had many cases recently where we've had income that's been stripped down to basically 30 or 40% of what it was, even when we can show that that was still consistent with pre-COVID levels for this exact reason. And there's really not much appetite for the banks to go outside of this. A couple have said that they'll assess of just most recent year financials, but a lot of people I think are going to be caught out. So it's a matter of, again, speaking to your broker, speaking to your bank, whoever you're getting your advice from, to see if you're in this bucket, are you going to be affected by this? And if so, how do we get around it? Well, the easiest option is to get onto your accountants and get your FY22s done. Having said that as well, I know there's the same problem exists in the FY22 financials, but from what I've seen, it's far, far less pronounced. And it might be, a lot of people aren't going to need 100% of the income that's in their financials to get the loan. If we can use 80% of it or something like that, that might be enough. If it's not, there are few and far between options apart from, more expensive low doc loan options, other than having to wait till FY23 kicks over and being able to present to the bank a full proper year's worth of financials. That's just about all the talking points I had. So thank you for those that are still here. No questions have come through on the Q&A, but I will just throw it out there in case I've prompted anyone that wants to ask anything now. Please go ahead. I know there were quite a few different points raised there. I've just had one through from Mr. Yelena. Thank you, Harry. What's the floor rate? So it's different for all lenders. Generally, they're going the actual rate for the loan product that you take plus a margin of 3%. So we've got a 0.5% rate increase pending right now. So for an owner-occupied loan, 3.8, 3.9% plus 3, plus another 0.5% when the current rate changes hit next week. So you're looking at, 8%, something like that. No, less, yeah. So yeah, it's the actual rate plus 3. Look, with none others that have come through, I will once again thank you all for attending. This will be recorded, so if you wanted to watch again, you can. And if you think of any questions afterwards, please don't hesitate to contact myself at the firm here. If you have a question for Orlane, I'll make sure it gets onto her as well. Thank you again for attending, everyone. I appreciate it. Bye-bye.
Thanks all. Thanks, Brett.